How important is the Fed cutting cycle right now? As I think everyone has reduced his or her expectations for the terminal rate. What are you looking at?
Well, I have the benefit of working with the Goldman Sachs economics team, and their forecast right now is the Fed will cut next week, as well as the beginning of next year. That's mostly priced into the market. The expectation for most portfolio managers with whom I interact on a regular basis are expecting an easing cycle to continue. And the stock market is pricing as though the underlying economic growth is closer to 5%. The economy, of course, is not growing as rapidly as that, but the performance of cyclical stocks relative to defensive stocks is more consistent with a pretty robust economic underlying activity. In fact, that is what most of the fund managers are anticipating. The animal spirits have really been out in force in the last month. We've seen the market rally by roughly 5% since the election. You saw recently the NFIB Small Business Optimism Index jump sharply. That's pretty consistent with what we saw in the first Trump administration. The expectation of more business-friendly environment, whether that's true or not, of course, that remains to be seen. CEO confidence is typically highest in a unified Republican government, so that also is, I think, one of the reasons why you've seen and we are expecting a 25% increase in M&A activity next year. The CEO confidence is one of the key variables, along with financial conditions and economic activity. So those are some of the attributes around why business expectations are pretty strong. The stock market is pricing that, and we have expectations of roughly 7% increase in the S&P 500 during the next 12 months to around 6,500. So that's sort of the lay of the land, Matt, as we see it now.
David, what do you tell people who are following the animal spirits? Should they keep following the animal spirits, or is there something more under the hood they should be looking at, given that when we look at your analysis, you're taking a look at a very, very specific set of stocks that should outperform and not just the entire index?
So we have a couple of strategies that we think about in this environment. One would be companies whose customer base or customer clients are small and mid-sized businesses. The intuition behind that is that companies that are small businesses are looking to spend more money in the idea of a more optimistic outlook. So if you're a supplier of those to those businesses, that's usually a good source of potential positive earnings revisions, more greater business. A group of stocks that my colleague, economic or stock analysts at Goldman, have identified as a greater than average probability of being acquired in a merger. That's a strategy. We published the other day, last week, looking at companies with a high risk-adjusted return. The idea of the expected risk-adjusted return being quite high in the coming year would be an appropriate strategy in our view, because the stock market trades at a very high valuation level. And there's a slight value bias or value tilt to a group of stocks with the highest potential risk-adjusted returns. And I think that's an important strategy to think about, given the uncertainty scenario around the tariffs, exactly what will happen with inflation, employment situation. So there's certain undercurrents of concern. And so the idea of choosing stocks with high risk-adjusted return, I think, is an appropriate way to set up a portfolio at this time. We think of it as terms of various slices of strategies.
I want to go back to the strategy you mentioned about stocks with a higher M&A potential. Obviously, we've been talking about the antitrust, the regulatory environment that's expected in 2025, especially with a new FTC chair named. Clearly, there's a lot of interest among Wall Street firms in that. What are your conversations with clients around that sound? Have you also seen an increase in interest from investors to pursue that type of strategy?
We have. In fact, the Goldman Sachs Financial Services Conference was held on Tuesday and Wednesday of this week, and there was quite a lot of the CEOs who were presenting, were talking about the expectation they had for increased M&A activity in calendar 2025. Investors, as a consequence, are also quite focused in this area. And we have a group of stocks where, typically, if you look at the S&P 1,500, 1,500, there's about a 2% of those companies get acquired each year. and a group of stocks to which I referred earlier, which my colleague analysts have identified as a greater than average probability. We have about a 9% hit rate of acquisitions. Those stocks tend to outperform, as you would anticipate. Receiving usually a merger comes at a premium. That's been a driving force behind why we get lots of inquiries looking at this list of 62 companies.
How do you look out, David, for black swans? I mean, we're in a situation where we really haven't had any for so long. The market's up almost 30% this year, the S&P at least. It was up 25% last year, and it's had an incredible run since the bottom in 2009 from 666 to over 6,000. What do you do to try and factor that into your models, the potential of an unknown unknown?
Well, since you referenced Donald Rumsfeld's famous dictum, known knowns and known unknowns and unknown unknowns, it's a question. Kind of hard to forecast a black swan. Well, one way, Matt, to combat that or to tackle that problem would be to look at companies with a high risk-adjusted return, because that's factored into a certain degree. Not a specific black swan event, but rather the idea of overall risk, the idea of a potentially high return adjusted for that risk, and that's a goal. That's the holy grail of all portfolio managers, to get the best risk-adjusted return that he or she can. So how do we think about it? Well, we look at some of the big macro issues that are there and try to understand valuation. The setup with the stock market trading at such high PE multiple does create asymmetries in terms of downside risk if there's real disappointments on the underlying fundamentals. So value has a potential component in a portfolio. I think the way to think about it is a portfolio in a true portfolio sense, with multiple strategies in place. Some that are maybe companies that are likely to have an M&A activity. Some that are forecast to have more customer base in the small area that we talked about, or risk-adjusted returns. Those combinations, I think, is a right way to approach a market that trades at a very high valuation, historically speaking. And that's, I think, that's how we would advocate and recommend to our clients.